So let's start with crypto.
Sure.
I'm what you'd call a crypto skeptic. You write about crypto, you write about stable coins.
Yes.
Why should I own crypto? Why should I consider this a currency? Days where people are freaking out, petrified of inflation, and they're selling the dollar and they're selling bonds and rates are going up, crypto should go up. And it doesn't act that way.
Yeah.
It acts the opposite to its thesis.
I'm going to construct an argument into three parts.
Okay.
2009 to 2019, if you look at that period, there were spikes actually in the opposite direction in which the currency went.
Not heavily correlated to NASDAQ.
Then comes COVID. Now it starts behaving much like the financial markets.
There's the actual coin.
Yep.
And then there's a technology underlying it that will have usage for payments.
That's it.
The two are not the same.
It's not the same, but they're interlinked.
How many coins are there these days?
Oh, God, loads, yeah.
What am I supposed to think about that? People always talk about Bitcoin. Should I care about any of the others?
Yes. From a utility standpoint, yes.
What do I need stablecoin for?
Okay. How do we deal with NFTs?
Stablecoin is not the same thing as Bitcoin
It is not
at all.
At all.
So let me ask you a question about Tether, because I've read that there's controversy around Tether, that people don't trust Tether. Tell us what that's all about. Okay, so let's start real basics.
Let me explain it as simply as I possibly can.
Okay. Hi, this is Steve Eisman, and welcome to another episode of my podcast. And today we're going to focus on crypto, stablecoins, and payments. And we have a very special guest today, Rahul Jindal, who is the FinTech strategist at Autonomous. Now, for those of you who have been watching some of my podcasts, you know that I prefer generally research from boutique firms because they tend to be independent. And I just find the research to be more in-depth and better. And 2 weeks ago, we had as a guest Dwight Collins, who's the head of institutional sales at Autonomous. We had a great conversation about all things financial. And so today we have Rahul, who is here to talk about his world, the world of crypto, stable coins, and whatever else we think is relevant.
Thanks so much, Stephen.
Thanks for coming.
Absolutely. Happy to be here.
So just give us a little bit of background so people will actually know, like you're entitled to have an opinion on this, because I want to say that on these topics, payments I can be very dangerous.
Yeah.
But on the topics of crypto and stable coins, I'm here to learn just like everybody else is.
Excellent.
So don't be upset if I interrupt you. I'm interrupting you because I don't know what you're saying.
Excellent.
So tell us about your background.
So I started my career in finance at Rolls-Royce, which is a jet engine manufacturer. Nothing to do with crypto, but this is going to come up later in the conversation, I'm quite sure. I spent some time at McKinsey.
Did you get a car out of it?
I did not. So they make jet engines.
You work for the jet engine people.
So they sold the car division.
Yes, now I remember. Okay, so too bad for you.
Too bad. Well, I still had a keychain, and this was one of the jokes I played.
It's not as good as a car.
Not as good as a car, but it was always funny when you get your Honda from the valley, and you're like, "Are you really? Right. Do you not look at my keychain?" Anyway, and then I spent several years at McKinsey as a consultant. Then went on and worked for Capital One in the corporate
company I know very well.
Capital One, the M&A team, the corporate development team. So saw quite a bit of deal flow around FinTech, during the crazy sort of 2018 to 2021, 2022 years. And then I've taken on a role at Autonomous as a strategist, covering FinTech since 2022.
So I've read a lot of your research.
Thank you.
It's quite extensive. So just so everybody understands, you don't just write about public companies. You write about crypto.
Correct.
You write about stable coins.
Yes.
And you write a lot. You write quite a bit about payments.
Yeah.
And you also discuss companies that are not public.
That's right.
So so let's start with crypto.
Sure.
Because that's where I think everybody's focused on these days. So I'm what you'd call a crypto skeptic.
Okay.
Not a hater.
Yep.
I don't like to hate.
Yep.
But a skeptic.
Yeah.
So let me give you a little bit of the questions that I have, and let's address them.
Yeah.
So if we were speaking 2-3 years ago, I would have said to you, I have 2 questions about crypto. One of them I'm going to address myself, and then I'm going to ask you the second question.
Sure.
And the first question is, why should I consider this a currency?
Yeah.
And over time, I sort of came to the conclusion, well, why is gold a store of value either? I mean, the only reason why gold is a store of value is because it's been a store of value for thousands of years. But there's no inherent value to gold because people treat it that way. So I think at this point, it's fair to say that there are enough people on planet Earth who think crypto has value to say, let's forget about that first question because it's sort of a moot point. So let me come to my second question, which I have never gotten an answer to. And I'm really hoping that you can answer it. Okay. So I remember during COVID, I did a lot of driving to and from the city. And I would listen to a whole bunch of podcasts. And some podcasts were about the history of Rome. And some podcasts were about crypto. And they all addressed a question of, they all said they skipped over the currency issue. So I skipped it now too. And they all addressed the following question. Why should I own crypto? Which is, I think, a very fair question. And the answer that each one of them gave was basically the same. And it was a version of that over the last 10, 20, 30 years, governments have been spending money like drunken sailors. The value of fiat currency, and for those of you who don't know what fiat currency is, that's government currency, has been debased. And, one day there'll be a calamity and people will toss out their fiat currency and they'll want to have something to have value. And so therefore, buy crypto. Basically, buy crypto as a hedge against Armageddon.
Fair enough.
Okay. So my question with respect to that thesis is, and you know where I'm going, because I told you before, is this. If that's the case, then on days like today, where President Trump made an announcement that he's going to delay the European tariffs. So NASDAQ is up, NVIDIA is up, interest rates are down, the dollar is rallying, crypto should be down. And on days where people are freaking out and they're petrified of inflation and they're selling the dollar and they're selling bonds and rates are going up, crypto should go up. And it doesn't act that way. It acts the opposite to its thesis. And the reason why that bothers me is I'm a stock jockey. So let's talk about your old company, Capital One. Okay. Let's imagine I had a thesis. And my thesis was I'm going to buy Capital One because the Fed's going to cut rates and credit quality is going to get better and the earnings are going to go up. And credit quality gets better, the Fed cuts rates, the earnings go up, and the stock collapses. And if that were to happen to me, I would say, I don't know what I'm doing. Because I had an entire thesis. It came out exactly as I said, and the stock reacted opposite to my thesis. So as far as I can tell, the correlation between NASDAQ and crypto is quite high. So if that's the case, why should I own crypto if it runs counter to its thesis? That's my question. Please, God, answer my question.
Okay. So I'm going to construct an argument into three parts.
Okay.
One, we're going to split the performance of crypto in three sections. Pre-2019, so 2009 to 2019, 2019 into the pandemic, and post-pandemic, post the crypto winter. All right? Because the correlation between Bitcoin price specifically, and as a bellwether for the rest, and we can argue to some extent the smaller currencies, but Bitcoin to the S&P 500 and NASDAQ has differentiated between those three periods. So it's not quite as clean. If you look at the total correlation over that entire span of time, it's actually not as correlated as one would think it is looking at just the last few years.
Okay.
So, but let me start with that. So that's kind of foundation one. The second part of it is I do want to pick a point of contention with the premise of your thesis. What is digital assets? What are they? How do you think about them from the perspective of utility, usage, and then a store of value? Because I do want to come back to that point for a second. And that hopefully will influence looking ahead how you think about correlation with the S&P 500 and NASDAQ and so on. And I'm going to end it with where we are today, specifically around regulation, because I think that also has a deep impact on this.
Fair. Let's go to regulation last.
Sure.
And let's separate. Sometimes when you get in conversations with crypto people, they very much mix Bitcoin as a store of value with cryptocurrency or maybe stable coins as a payment system. And the two are not the same.
I'm not doing that.
Okay.
No. It's,
good.
Yeah. I'm talking about digital assets.
They conflate the two
Correct.
often.
I'm talking about digital assets as a technology.
Okay.
On top of which are numerous assets. Let's call them assets for this purpose. Bitcoin being one of them, right? So I'll come back to that. So let's start with the first sort of the history behind this, right? To talking specifically about correlation. So if you split into three, what's happened here, from 2009 to 2019 or so, there actually wasn't strong correlation between the financial markets and specifically Bitcoin in this case, correlation as the main kind of currency of circulation. If you look at that period, there were spikes actually in the opposite direction in which the currency went. One example is the Cyprus banking crisis. It actually went deeply in the opposite direction. And part of the rationale during those 10 years was that this was, to your point, a hedge to what banks were doing. So during the
So you're saying from 2009 to 2019, it acted more often than not according to its thesis.
Correct.
Okay, I'll give you that.
Which again, like I do pick a point with the thesis being that it is in fact not a correlated asset. I don't agree with that fundamentally. I think it's still a developing.
No, my thesis meaning it's a hedge against fiat currency.
Correct.
That's that thesis.
Fair point. Yeah.
Okay.
So 2009 to 2019, it's really not heavily correlated. There are actually spikes of instances.
Not heavily correlated to NASDAQ.
To NASDAQ and the S&P 500
and the S&P.
generally, right?
Okay.
So we've kind of got this asset that's there. The usage is limited. You have some enthusiasts that are owning it. There's a thesis, the point that it hedges against Armageddon, frankly. So when you have instances where people do feel like Armageddon's coming around, you have a massive spike in Bitcoin prices.
Right.
Okay. So it kind of tracks.
Let's go after 2019.
Then comes COVID.
Right.
Now it starts behaving much like the financial markets.
Right.
Because partly as this currency starts getting adopted, you have the growth of exchanges. You've got Coinbase coming on. Retail investors are getting excited. They're putting their money in it. When people start to draw money out of the financial markets, they start drawing money out of crypto as well. So it starts correlating far more strongly. In many cases, even there were spikes during that period around the 2020 time, March, April, when you had a massive downturn in the market where it correlated heavier to the NASDAQ exchange than did gold.
So NASDAQ went down, crypto went down.
Crypto went down. And it went down with a higher correlation factor than did gold during that time.
Okay.
So you start seeing this correlation developing very strongly during that period. Consequently, once you have quantitative easing, the same trend holds true. Crypto prices go up.
Right.
As the market goes up, crypto prices go up. A lot of it is, again, oriented around retail investors because you really don't have institutional players at this point, right? Then we're beginning to see some decoupling now. So once, you start hitting the end of crypto winter, you start hitting 2023, now the spot ETF gets passed, BlackRock starts playing a role, BlackRock then comes out, their funds talking about 1% to 2% of allocation going into this. Now you start seeing a degree of decoupling, and you can see that in the correlation coefficient. You start seeing a degree of decoupling where it stops behaving, I don't want to go all the way and say it becomes completely decoupled because it does thrive in a risk-on scenario and it doesn't do well in a risk-off, which you would expect. But it starts decoupling, and crypto-specific news does drive variance in the pricing relative to the market.
Look, I think lately it's coupled more to the whole regulatory situation, and people want to own it because they think it's going to be institutionalized.
Yep. Correct.
I agree with that.
Yeah.
Although I am still disturbed by the fact that more often than not, it's correlated to NASDAQ, which runs counter to its thesis. So I guess you have to take the position that it's still in its infancy.
Right.
There's a lot of immature investors in it, and you either believe it or you don't believe it.
And
if
that's
you believe
my second point, Steve.
Okay.
That's my second point. So this is the history, right? So when you look at it towards the, from 2009 to today, the correlation isn't over that span of time as strong as people make it out to be over the last 3 years, relative to the last 3 years. Now, let's pause this for a second. Let's look at your very thesis, right? What is it? What is a digital asset? Do you think of it as I like to think of it as three things happening at the same time. It is an infrastructural change in how we think of money that correlates with not the financial markets, but the usage of money in this, with respect to the emergence of e-commerce. We are not spending money the way we used to 50 years ago. And most of the payment systems that have evolved over this time are not built for the e-commerce economy, are not built for the internet.
I'm going to challenge that a little bit later. But I hear what you're saying, that at least the technology that backs, like I said at the beginning, there's the actual coin. Bitcoin and the other ones, and then there's a technology underlying it that will have usage for payments.
That's it.
The two are not the same.
It's not the same, but they're interlinked. You need a medium of exchange in order to facilitate a transaction on the baseline
But you could also
system.
eventually have a digital dollar. So that then
well, yes and no, but the fundamental foundation, I say no because, I mean, they're trying to outlaw that fundamentally. But at the fundamental basis, but my point is, if you leave that aside and you look at what is this thing, and then that's where I challenge your thesis a little bit, is when you look at what is this thing, it's a store of information first, right? When you look at our traditional banking system today, financial services system, these are ledgers that are owned by banks or payment companies, and there's a massive ledger that is that correspond with links with corresponding banking and allows payments to happen, right? But these are fundamentally ledgers that are owned and independently operated by companies that have interlinkages. Digital assets are a store of information that's distributed. So it fundamentally challenges that thesis. So there's utility in the fact that it enables commerce to happen at higher velocity and a cheaper transaction value. Well, that's the utility point.
It ain't a cheaper value now, and it's not a higher velocity than Visa, MasterCard. I mean, we'll come to that. We'll come to that eventually. So, okay, so I understand what you're saying. Let's stick with the crypto part first.
Yeah.
So there's not just Bitcoin. Let's talk about, I mean, how many coins are there these days?
Oh, God, loads, yeah.
And so what am I supposed to think about that? That there are just so many variations of this. I mean, people always talk about Bitcoin. Should I care about any of the others?
Yes, from a utility standpoint, yes. So let me rephrase that a little bit. You should care about the ones that drive ubiquity and have a depth of liquidity to it. Okay, so much like you care about Visa and MasterCard as a network, and you don't care as much about Starbucks's the app. It's a closed loop payment system.
Right.
It exists.
Gets me coffee.
It gets you coffee, but you don't talk about it that much.
Right.
Because there's a certain degree of ubiquity to Visa, MasterCard, and Amex. Similarly, these currencies have a degree of ubiquity relative to others. That's kind of
what do you mean by ubiquity relative to
more
others?
People accepting, knowing it, knowing of it, knowing that if I talk to you about Bitcoin, you'll think there's a degree of trust to it. To your very first point, that enough people on earth think it's valuable, so it must be valuable.
Right.
But if I said, Steve, I'll give you Dogecoin or give you some other unknown.
They'll say, what the hell is this?
You'll be like, what is this? Right?
Right.
I don't. So there's a degree of ubiquity. The second is the liquidity behind it. And this is really important as we move our conversation to stablecoins in the future as well. The depth of liquidity drives almost like a network effect, right? The deeper you have, the more people are willing to take a chance on it. More merchants want to integrate that into their payment scheme, and so on and so forth. That's kind of the case around it. So that's why you should care about some of these assets that are more well-known and are used versus others.
Like
Bitcoin being one.
Bitcoin, what else?
Bitcoin is for very large transactions. That is how it works. Ethereum. And Ethereum has loads of applications, layer 2 built on top of it. You can put wrappers around coins and transact on different rails. I've done this before when I've bought NFTs. Obviously then there's the entire stablecoin economy that's being built upon this.
Let's leave aside stablecoin. We're going to do that next. Yeah. We're still on the coins part.
Yeah. Litecoin. I mean, there are loads that have displayed good value to them. See Ripple.
So let's get back to Bitcoin for a second. So if I grant you that it's a young market and it's in its infancy, so how it acts now may not be how it acts 10 years from now. Mm-hmm. Okay, I'll grant you that.
Sure.
But if someone was to say to me, one day you will buy stuff with Bitcoin, My response to that would be, how could that be? They're going to run out of making it at some point. There's only so many Bitcoins that are going to be issued.
21 million, yeah.
Right. And at that point, there's no more Bitcoins.
Right.
So how are you going to have something called Bitcoin and have it a currency and have people transact with it when there's only so much of it?
Fractional. It's fractional. It's fractal. Fractional is the most simplistic version of it. It's fractal. What do you
mean it's fractal?
You could split it. You could keep splitting it.
I see. Okay.
It's fractal. So the other finer point around this, Steve, I want to add is you've done payments for a lot longer than I have. Getting people to change how they pay for things is not an easy ask.
No kidding.
Right?
And by the way, let's say I was to go buy something.
Right.
Someone would actually take it.
Yes.
Let's say I could buy a car.
Correct.
With Bitcoin.
Right.
Versus I could buy a car with my Visa MasterCard.
Correct.
Grant me that it's a lot cheaper in terms of total transaction fees to do with a Visa MasterCard than it is to do with Bitcoin. I mean, how much more expensive is it going to be to do with Bitcoin at this point?
I would venture a guess if you do it at the right time, with the right company, it would not be all that more expensive than you think it is at the moment. I'll tell you that. And I don't say Bitcoin. I think you've got to be a bit more flexible which asset you use. And I'll come back to that. I'll come back to stablecoins doing it. But it's not as expensive as you think it would be. Okay. Versus a traditional 3.5% interchange plus on your transaction on a credit card.
There is no 3.5% interchange on my credit card. There's at most 1.5% interchange on my credit card.
3 points is what the merchant is losing, give or take, right? Plus minus. So I'll give you an example.
Okay.
Stripe. They charge 2.9% plus fees, correct, on every transaction. I don't know if your car merchant is using this. I'm sure they've got something else, but just stay with me. If you run a transaction on the stablecoin partnership that they have, it is half that now.
Okay, let's go to stablecoin. Okay, so let's start real basics.
What is it? Okay.
Because stablecoin is not the same thing as Bitcoin at all.
At all. Well, similarities, but
it might have similar technologies backing it, but it has different purposes.
Let me explain it as simply as I possibly can.
Okay.
So a digital asset, be it a Bitcoin, Ethereum, whatever, is run on a blockchain, right? Which is essentially a very large ledger that everybody can look at. It's got permissions on it, and you can run it in a permissionless way, but fundamentally it's a very large ledger. It is immutable, audit trails, and so on. You can build currencies on top of it. Bitcoin is one of them. Now, what a stablecoin is a digital asset that is backed or is linked to X. And you can put that X in as a dollar, as a euro, as a yen, as an Indian rupee, whatever you want. So it is a one-to-one relationship where if I give you or I issue a stablecoin, one Rahul stablecoin, I have to have a dollar, a US dollar in this example, in a bank as a custodial asset against that stablecoin. When that stablecoin is redeemed or dissolved, that dollar goes back into the pocket.
So let's do it. Let's say I'm going to do a transaction.
Yeah.
And I'm going to pay somebody with stablecoin. First, I got to buy a stablecoin.
Correct.
Okay. So I go and buy a stablecoin.
Yeah.
Who am I buying it from?
An exchange.
An exchange.
So you would have Coinbase.
Coinbase.
Do you remember the Mickey dollars or the Disney dollars back in like 10 years ago when I went to Disneyland for the first time? You'd give a US dollar, they'd give you a...
Yes.
It's the same principle.
Okay.
So there's an exchange.
So I thought Tether and Solana are like the biggest exchanges for stablecoin.
Tether issues stablecoins.
Right.
Right. And Tether is one company.
And Solana is another one.
There are, yes. And then a handful
So if I buy
PayPal, Ripple.
a stablecoin from, let's say, Solana.
Mm-hmm.
So let's say I buy $1 million worth because I'm going to buy $1 million worth of stuff from somebody.
Sure.
So I basically walk me through how I interact with Solana and what happens.
So you would have essentially a wallet, right? Which is the ability to on-ramp your US dollar, your fiat currency, and convert it into a stable coin, whatever company that may be.
So I basically buy $1 million worth of stable coins from Solana.
That $1 million cash that you now gave them in US dollars will go into a custodial account.
Okay.
Right? That custodial account Big banks like Bank of Mellon, New York maintain them, and so on and so forth. It goes over there. You've got an auditor that says you have $1 million worth of stablecoin issued, and we can see you've got $1 million worth of USD.
And what does the bank hold? Treasuries?
It's a custodial account, yeah, treasury
They
function.
just hold treasuries.
It's just like you would with a normal financial institution, right? So bank holds it, auditor audits it. Everybody's very clear that there's money that backs this particular digital asset that's issued. That company is probably making money on the yield, as you can imagine, because some of them are US dollars, most of them are short-term treasuries and so on and so forth, right? Repos and so on. So they're making money on that. Now, you can use the currency that you have issued, the stablecoin currency, to transact. Whether you buy a car, or you buy a house, or you buy coffee, it doesn't matter. That person that is now accepting your stablecoin has to redeem it. So they go through their financial services institution that then swaps it back for US dollars if they so choose and deposit it into the bank account.
So it's a way to pay people.
Or transact, remittances, loads of different use cases.
So if I do it through Solana, I got to pay Solana a fee. Don't I pay Solana a fee in its digital currency, Sol?
You would pay them a fee.
In their digital currency.
Yeah, exactly. But it comes out of the same dollar pool, right?
Yeah, I understand.
Yeah.
But, I mean, let's say it's $1 million and they charge, let's make up a number, they charge $1. I don't know what they
Yeah,
charge.
yeah,
Let's say they charge
sure.
$1 for the whole thing.
Right.
That dollar is paid to them in Sol.
Correct.
So if Solana becomes the stablecoin network and it takes off, I should invest in Sol because everybody's going to need to pay them in Sol.
That's the utility point. That's exactly the utility point that I'm speaking of. But when you pay them, this is the big difference. That with a stablecoin, it's backed one-to-one. There's not very much capital appreciation. You can believe in the utility of the company and buy stock in that, and that makes total sense. But you're not so much believing in the fact that there's going to be capital appreciation of a one-to-one dollar reserve. Why would you do that?
No, that's not my point.
Yeah.
My point is you got to pay them a fee.
Yeah.
And the fee is going to be in their digital currency.
Correct.
So like I said, let's imagine a world where stablecoin really gets big.
Yeah.
And let's also imagine a world where Sol is the Visa of stablecoin.
Correct.
I should buy Sols.
You buy Visa, right? If you buy Visa stock.
No, I want to buy Visa. I want to buy Sol because people are going to need to buy Sols to pay them. They pay their fee.
Makes sense, but you can keep buying them. But there's always a dollar reserve against. That's my point. There is no. It's how would you have capital appreciation in that case?
What in Sol?
Yeah.
Isn't there more of demand for Sol?
There's demand for Sol, but there has to be a dollar against each Sol that they issue, or each USDC or Ripple coin that they issue. Ripple USD, not XRP, just to be very clear, right? The RL USD coin. There's a dollar behind.
So you're saying that Sol is going to be pegged to the dollar?
No, I'm not saying Sol's going to be. If there is a stable coin, I'd rather not get into the
No, I'm not.
gritty details
I'm not
of
talking about that there's no appreciation in the stable coin.
Correct.
I'm talking about there will be appreciation in Sol.
In the
currency that you are going to have. Make up a simple story. The whole world goes stable coin.
Yes.
The whole world only uses Solana.
Okay.
And everybody's got to pay Solana in Sol.
Right.
If that happened, I guarantee you one thing. The price of Sol is going up.
Sure, but again, I think we're getting confused in two definitions here. A stable coin is backed one-to-one with the US dollar.
I completely acknowledge
You can
that.
have initial coin offerings, you have ICOs, you can have tokens that are not backed one-to-one.
Yeah.
They can appreciate. So if you look at Ripple, for example, XRP is a token that can appreciate. RLUSD is a US-backed stablecoin.
No, the stable coin doesn't appreciate. Correct. That I understand.
Yeah, but
so let me ask you a question about Tether.
Yeah.
Because I've read that there's controversy around Tether, that people don't trust Tether. Tell us what that's all about.
So look, I mean, this is my view, right? I'll tell you.
Well, before you even tell you your view,
yeah.
What's the story that people are worried about?
So look, I mean, there are three things that happen over here, right? One is who's using this? Do you have enough KYC and AML and so on and so forth to ensure that there are no nefarious uses that are playing out on your chain? Okay.
What, nefarious uses of digital currency? I'm shocked.
Right.
I'm shocked this is going on.
I mean, you see that point, right?
Yes,
so who's
of course.
Using KYC, AML? That's kind of
so nobody's going to want to do stablecoin through an entity that they don't trust. That's part by definition.
Right.
That'd be like saying, if I didn't trust Visa and MasterCard, I wouldn't use my credit card.
right? Or if you thought there was nefarious activities of wrong players and so on and so forth, right?
Right. Look, if I thought every time I swiped my credit card, somebody got all my information and started creeping into my bank account, I wouldn't use my credit card.
Right. And
so if I was worried that there's a bad guy at some point in this stable coin network, I'm not going to use it.
That's right. And I think there's a certain degree of also, if you had a bank.
But why are people picking on Tether as a potentially bad actor?
So because in the past there have been instances where they've been linked, or the currency's been linked to
what currency's been linked?
Tether.
Tether's currency.
Yeah, the currency, the stablecoin is. Look, I don't want to speculate. It's not my role, but there is a perception.
Go ahead, speculate.
There's a perception out there that there have been nefarious uses of that. That's one. The second part,
nefarious uses that people have
that is being
been
used
money laundering
correct,
stuff.
Exactly. AML and KYC has been weak.
What's KYC?
Know your customer.
Know your customer.
So that's one part.
Yes.
The second part of it is custodial accounting, which is very important. So as I mentioned earlier, when I give you $1 and you issue a stablecoin against and I buy that stablecoin, I need to know that if I redeemed it, I would get my $1 back, correct?
Right.
Otherwise, why would you ever participate in this? So that means
that has to be ironclad.
That has to be ironclad, which means you also need to know for a fact that that money is being held in the right reserves with the right type of bank, audited by.
So in other words, I need to know
auditors.
that either Tether or Solana takes that money and they're buying treasuries, not marijuana.
Exactly. You get my point, right?
You also, and I need to know that somebody is watching those guys to make sure
that's right.
that what they say is true is true.
Right. That's right.
Okay. So why are people worried about Tether?
Well, relative to
where is Tether based, by the way?
Outside the US. I think El Salvador. I have to double check that.
Oh, that's not so great.
Right. So
and where's Solana based?
I'll have to double check that as well. I'm not quite sure.
Probably in the U.S. is my best.
But there have been companies like Circle that are very U.S. based and so on and so forth. So there's, PayPal is obviously U.S. based. Custodial accounting is cleaner. They have name brand auditors like Deloitte picking up the Deloitte check.
So people don't trust Tether because it's not based in the U.S. It's dicey.
And the assets that support the or the custodial assets. And when I say custodial assets, I mean, once I've taken my $1, I don't need to necessarily hold it in $1, but I don't want to be buying something that is a risky asset. Like I don't want to have, a digital currency also in the custody account.
Yes.
Right? Because that adds a lot of risk.
Yes. All right, I understand. So Tether could be a problem because of where it's based and maybe they're not trustworthy And listen, if people are big boys, if they do stable coins through Tether and they get screwed, shame on you.
Yeah.
Let me talk a little bit more about stablecoin and payments. So, like you said before, I've been doing payments longer than you've been doing payments.
Yeah.
Okay. And from an old timer, let me tell you something that's been my experience. Ever since Visa and MasterCard went public, which is like, 2001 or something like that. So I would say, and I've had this happen to me many times, and it didn't matter what firm I was at, it didn't matter what year I was at, that every 3 to 4 years, people would come into my office, whether I was running a hedge fund or I was at Neuberger, and they'd make a presentation. And they would basically say, we're the new kid on the block in payments. And we got this great technology and this great story. They had a whole deck and it sounded awesome. And we are going to, what was the word they always like to use? Disenfranchise Visa and MasterCard. And and the first time I heard it, that sounded reasonable. And then, but what would happen is 2 to 3 years later, they'd come back and we'd say, what's going on? And they go, not happening.
Hard.
It just can't happen. It's not happening. And then they would also say, and we're working with Visa and MasterCard. Every freaking time. Okay. So consider me a skeptic on stablecoin because it sounds like this is another story of disenfranchising Visa MasterCard, and I've heard this before. So let me press that point. This is full disclosure. I've owned Visa for like God knows how many years. I don't even think about it. It's the greatest business model I've ever seen in my entire life. But leave that aside. So the last several years, both Visa and MasterCard have added services to what they give to customers other than just the network.
Right.
So here are two. So let's talk Visa Plus and Visa Direct. So Visa Plus is, for those of you who don't know, prior to Visa Plus, let's say I went to a restaurant. You and I went out to eat. and I paid the bill.
Yeah.
And let's say the bill was, I'm just going to make up a stupid number. It was expensive dinner. We had some really good sushi, and it was $500.
Yep.
And I said, I'll pay. And then after I took out my credit card and I paid. And then you said, no, Steve, I insist that we split it. I said, okay, Venmo me.
Yep.
So you have a Venmo
Yep.
and I have a Venmo account.
Yep.
So you go into Venmo and you Venmo me $250.
Yep.
Done.
Yeah.
Okay. However, same situation. And you say, I got to pay you, I'm going to pay half. But let's say you have Venmo and I have Cash Plus of Block. You can't pay me.
Correct.
But because of Visa Plus, that gets added to Venmo and Cash Plus. And now all these consumer-to-consumer payment systems are interoperable.
That's right.
Because of Visa, I like that word.
Yes.
Because of Visa Plus.
Yes.
Okay, let's leave that aside. It's seamless.
Yep.
It's immediate.
Yep.
Because of Visa Plus, it's a global network.
Correct.
I mean, because of Visa Plus, I could pay somebody in Bosnia.
Sure.
Okay. Then there's Visa Direct.
Yep.
This is business to business.
Yep.
So this is a way, basically, not to get too technical about it. I'm a auto parts company. You're an auto manufacturer.
Yep.
You got to pay me
Yep.
because I just sent you all these auto parts. And in the old days, what would happen is you'd have a whole accounting department. I would send you a bill.
Yep.
You would write me a check.
Yep.
Till I sent you the bill, till you wrote me the check,
Yep.
till it all cleared.
Yep.
Could be 2 weeks.
Right.
Now, because of Visa Direct, I send you a bill electronically.
Yep.
And through Visa Direct, you pay me electronically.
Yeah.
Bada bing, done.
Yeah.
Okay. What do I need stablecoin for?
Okay. So 2 points. Digital assets are a candidate amongst many other pieces of technology, including Visa value-add services, which obviously you referred, which is a large part of their revenue now. It is a candidate. I can extend your metaphor even further to say, let's look at India, for example. UPI is free under a certain...
you better explain people what you just use the whole thing.
Yeah.
In India, there's a payment system called UPI.
Correct.
Not Visa MasterCard.
Not Visa
they
MasterCard.
created it themselves.
They did it themselves.
I'm just trying to slow you down
Absolutely.
because the world you live in is not on planet Earth.
Fair enough.
Okay.
I mean, I can give you money
in India
by scanning a QR code. You could be selling me coconut water on the street.
Right.
And instead of giving you cash, I could scan your little code and transfer you money. Immediate payment. No questions asked, right?
Right.
Now,
it's their version of Visa MasterCard, but probably maybe even better.
Correct.
Okay.
And
it's similar.
My point is, that is a candidate for that particular country, and they're exporting it to other countries now. It also does identity and authentication management. So when I pay you, Stephen, I know I've only paid you and nobody else.
Right.
And you know you've received it from me, right? And so on and so forth. Get directly deposited.
But getting back to my point, so if I'm a business,
right?
Okay, I got to pay bills.
Yeah.
I'm thinking about this from the perspective of, the man or woman who's in the payments bill department of General Motors.
Yeah.
This is about as mundane. No offense to people who do this,
No, sure.
but this is a bread and butter thing that General Motors does.
Yeah.
That has to work 100% of the time.
Yeah.
Because God forbid something should happen, the CEO is going to find out about it.
Okay, so
I'm that person.
Yeah,
right?
I'm glad you brought
and
that up.
I know that if I use Visa Direct, that payment is going through.
Yeah.
Visa's there to protect me against fraud.
Yeah.
And they do.
Yeah.
And I never have to think about it. I never have to worry about it. Why would I use stablecoin?
Fair point. So there's 2 points I was trying to make. So one is...
I think I got you.
I don't think you did.
Maybe not.
But, okay, so the first point is they're not challenging Visa and MasterCard.
Stablecoin.
They are not. Even from the perspective of credit card payments, right? This is something that is an invisible technology to the end user. Whether it goes through the traditional Visa rail or it goes through a stablecoin rail linked with Visa, because right to your point about if I may finish.
I understand, but stablecoin is in theory a method to to send money from here to there for whatever purpose.
But as you realize, obviously there are lots of things around it which the network benefits the merchant with. Things like chargeback protections, things like insurance, things like, if the person returned the item, now what happens, right? Where does that money get routed back if a return is made? All of that is hard to build. That's why Visa and MasterCard are so hard to disintermediate, which is in my view, is going to stay. Stablecoins provide an alternate route for payment, but still need these capabilities that Visa and MasterCard and Amex are providing them. So I think the world that we're going to live in is not going to be one where there is any point in taking down that network that has all of these interconnectivities already built out.
All over the world.
All over the world. And every merchant, you can accept it.
So you think stablecoin will go through the rails?
Exactly.
So here's my question, though. Okay, I'll grant you that.
Okay.
Why is there a use?
Yes, let me get to that.
Stablecoin that I must put this way. If it's a competition between should I pay with stablecoin or should I pay with Visa Direct, if that's the choice,
which it isn't. That's my thesis.
Go with me for a second.
Yeah.
If the selling point of stablecoin is it's a method of payment.
Yeah.
And if then people are faced with the question is, am I going to use stablecoin to pay or am I going to use Visa Direct to pay?
Right.
Visa wins that every time.
Right.
So my question is, and this is a very interesting question. What would I use stablecoin for?
Yeah.
That is the best alternative use.
So it's a great question. So I think let's step back for a second. There's a buyer and there's a seller. I'm going to go back to your GM example. There's a buyer and there's a seller. What's happening is from the buyer's perspective, you and I, customers, okay? The payment technology is largely invisible today, and I suspect it's going to be invisible in the future. Most human beings, if you pick somebody off the street, doesn't know how a PayFac works.
How what works?
A payment scheme.
A payment scheme.
Right? Don't know how the payment scheme works.
No, they have no idea. They just know they have a credit card that says Visa.
And it works, right? They swipe it and they can pick up a bottle of water and walk out the store.
Right.
And it's all the same, right? I don't think that changes. I think technology is good when it is invisible to the end user. Mm-hmm. I don't think people are going to go out of their way to switch the path in how they pay. I think what's going to happen is that this rail will start becoming more adoptable by merchants if there is two things that happen. Velocity of payment increases or the cost goes down, and or both.
Yeah, but again, my question is, if it's a choice in payments between Visa Direct and stablecoin, Visa Direct wins. What can stablecoin do that Visa Direct can't do?
If they can make the velocity faster and they can drop the price lower, then they win. But I don't think they're competing with Visa and MasterCard. That's my whole point.
Okay, so what are they competing with?
They're competing with SWIFT when it comes to cross-border. They're competing with
I can't do cross-border through Visa Direct?
Well, not the same volume. The current Visa Direct doesn't have the same volume today that SWIFT does. I mean, it's still a tech.
Tell people what SWIFT is.
SWIFT is if I'm sending money to India, if I want to send $10,000 to a bank account in India, I may be using a JP Morgan Chase account here, and I'm transferring money to Baroda Bank in India. Right now,
by the way, I've been to Baroda Bank.
Have you?
I have. I used to go to India. We used to have investments. It's an old bank.
It's an old bank. Yes. They have accounts. Now, if I'm transferring money, somebody has to say, okay, number one, we're going to take $10,000 here, make sure it's going to the right bank account in India, to the right person.
So you see it as a money transfer business, stablecoin?
Absolutely.
Okay.
Absolutely.
Maybe. I mean, that's not the biggest business in the world.
It's not bad. Countries that are very dependent on remittances, if you think about it, and it's a large economy. And you're
basically saying it's a replacement for what's the name of the company that people always go into and walk into the store and send money?
Wise, no, not Wise. That's the new one. Western Union.
Western Union. So you're saying stablecoin is a replacement for Western Union?
I think that the switch happens in the following way, in the following use cases. Velocity of money, I keep saying that. It's can you make the payment go faster so the person who's receiving it gets it faster than they would yesterday?
Right.
One. And two, is it cheaper? And if those two are checks, or one of them is a check, that is generally a good business to be in.
Okay.
Right? Cross-border, domestic payments, P2P, you call it a thing. That's why Venmo won, right?
Yes.
So that's kind of one part.
By the way, the first time I used Venmo, I was very proud of myself. My kids were proud. They couldn't believe that I actually used Venmo. It works. It's so seamless. It's unbelievable.
I think the second part of this that's also very important as we continue building upon this is a store of information. So if I go back to your Visa example, right? It's a dual message system fundamentally. When I swipe my credit card, a message goes through from the merchant, Starbucks's bank to my bank, the issuer, and says, okay, Rahul's good for the money. Let him have the cup of coffee on credit, right? Two messages are being swapped. What blockchain does is it allows you, and stablecoins really, allows you to put a lot more information in that message. So you can not only push it, and I want to come back to your GM example. It's a very good question. You can not only say, yes, you bought a cup of coffee. You could say, for companies like GM, if you're paying a bill, you say, what part was it for? Right. So if I go back to my old,
I see. You could load it up.
You could load it up with information.
Okay.
Even Fed now doesn't do that. I can see the
point. I just, when I see people sometimes go on CNBC, and they're like religious zealots with respect to Bitcoin and stablecoin, I get skeptical.
I understand
because
that.
For the reasons that I said.
Yes.
I've heard this drill 5 times in the last 20 years.
Correct.
We're going to replace Visa, MasterCard. I'll stick to my Visa stock because it's just too good a business model.
I don't think
if you're saying to me that stablecoin will have a role in the payment system,
Correct.
I'll grant you that.
It's a horse in the race. Now, what I do also want to make a finer point on this is if you look at domestic payments, let's just say U.S. credit payments, right?
Mm-hmm.
If you look at the 3% right, that the merchant is basically you spend $100, they're really getting 97, right?
Right.
That 3% Off that 3%, the network fee, the Visa MasterCard
it's
fee,
like
as a
12
percentage
basis points.
is very, very tiny.
Oh, it's tiny.
So why would anybody go out there and try to build all of the capabilities that Visa and MasterCard is offering
for just 12 basis points
for that tiny part of it?
Oh, I agree. It's not going to happen.
Same argument when I published my report on Apple Pay. It's the same argument I had then. Why would you challenge that? Why wouldn't you challenge the rest of it?
Right. Okay, fair. Let's talk what's going on in the regulatory world.
So it's a really interesting space right now, Stephen. So what happened is now, after the election especially, this government is very pro-crypto.
Right.
And they have done it in a very sequential manner. So let me do you mind if I rewind the clock a little bit? I'll take a minute. Okay. So I think of regulation in essentially 4 phases. So you had kind of the beginning of this. It was kind of, I'd say, like 2009 to 2000 and call it 19, roughly, give or take. Wild West.
Wild West.
Right? No regulation. The biggest issue was, and tell me if this is too much detail, but biggest issue was people didn't know if this was a commodity, a security, or a currency.
Right.
And if you don't know the three, you can't tell the three apart, you can get into real hot water with regulators because you may be using something and suddenly the SEC comes and says, oh my God, that's a securities
contract. There's a whole new bunch of laws you got to read
and you will go to jail. And people did. So that was the Wild West. So because of that, most traditional financial services companies did not partake in this.
They couldn't.
Right? They couldn't. Then you come to the next phase where you've got some companies that have grown up, FTX being an example. No governance, offshored, because there wasn't regulation here, you got some big problems. And that starts depreciating.
More than big problems.
Starts depreciating. Fraud.
Right.
Starts depreciating the trust in the entire technology.
Right.
Right? And you had Celsius, you had FTX, and so on and so forth. Then comes a heavy hand from regulations. So the SEC came down and they started suing companies operating in the United States that had touched digital assets that were, either doing this business or associated with this business. And there were sort of things like Operation Choke Point, where, there were agencies such as the SEC, OCC, and so on, that by basically encouraging traditional finance not to even open bank accounts for companies that were operating digital assets. So you went into this phase that was a regulatory nightmare for digital asset companies. Then comes the election year. Then suddenly, people start realizing elections matter. And there is a crypto lobby, and the lobby is lobbying for cryptocurrencies. And the Republican Party came out ahead of this, knowledgeably so. There was senior senators like Senator Lummis that had been invested in this space. And by the way, so were the Democrats in some instances, like Senator Gillibrand, that started putting legislation out there for draft. And it started clearing the path a little bit, and it became an election issue, a serious election issue. Some of the most expensive Senate races were fought and won on.
Okay, so where are we today? How is all this stuff going to get regulated?
So there are three buckets I want you to think of when it comes to regulation. One is, how do we govern the entire thing, which is called market structure.
Right.
All right. So there are good products in the House, good products on the Senate, bills that have gone through quite a bit of drafting and revisions. Most likely that the general consensus is this will pass by the end of the year.
Okay.
Before the end of the year. That governs the entire thing. That's part one. Part two is a carve-out that only deals with stablecoins.
Okay.
And that is the 10-meter target. So there are
What does that mean?
10 meter, very, very close. This
very
is going to
close.
happen even faster. So we have two
I mean,
bills.
I did inches and feet and yards, not meters. Okay. I understand. You
can
come
tell from my
I come from
accent.
a different country.
Right. I still have, yeah.
Somebody says meters, like, oh, whoa, what does that mean?
So that is the
That's near term.
near term, right?
So
And
how is let's assume that what's in front of them passes. How is stablecoin going to be regulated?
so the genesis of this is it is going to be under the OCC,
Right.
most likely.
The OCC.
The OCC.
The Office of
The control of the currency.
Control of the Currency.
COCC, and it is essentially the bill that we're talking about here. There's the two parts to it: stable and genius. Senate and House, very close to each other, roughly. Old civics lesson, you need to have this, Yep, and the president signs it. Most likely,
There was a Schoolhouse Rock about that, when I was growing up, there was like they had all these things. Like conjunction junction, what's your function? Then they had this, I'm just a bill going up to Capitol Hill. That was and that's how it became a law.
I might actually look that up.
You got to look at it. It's absolutely wonderful.
Yeah. So fundamentally, the three things to keep in mind on this is one, it's OCC and as a governor of the group, under $10 billion in market cap is going to sit at the state level.
Okay.
North of $10 billion, it goes up to the federal level.
What do you mean?
The market capitalization of the stable coin.
Okay.
So if your market cap is below 10, you can be at the state level, much like traditional banks.
Right.
If you breach the 10 billion, then you have to apply, and you get.
So what about the legislation for Bitcoin? How is it going to be treated? As a security, a currency? Like how's it going to be? Who's going to regulate it?
So that will fall under the market structure bill, the first one I talked about. So
right.
Because it's not a stable coin.
Right. And who's going to be the regulator? I heard it was like the CFTC, Commodity Futures Trading Commission.
Correct. Most likely, most assets are going to be considered commodities.
Commodities, not a currency.
Not a currency. With a carve-out if something is clearly a securities or securities contract.
I see. Okay.
And in which case the SEC would pick up. That's the now. Between now and when that thing actually gets debated on the floor, things can change. But that's the most likely outcome. And then, if I may add, there's a third bucket of a splattering of other bills, right? So things like how do we deal with NFTs, the NFT Act, right? How do we deal with US-based companies, if we think of this as a national technology or a technology that has a national security implication, right? So how do we think of US domicile versus non-US domicile? So there's a splattering of bills that I put in the third bucket. The one I find most interesting is the reserve, the Bitcoin reserve. Do we start buying Bitcoin as a national reserve?
And by the way, getting back to the thesis about owning Bitcoin as a hedge against currency, I sort of have it's like my joke about the whole thing. So you'll excuse me. My joke about it is just that there are very few people in this world who are going to put, a significant percentage of their net worth in Bitcoin. There's some, but
don't you wish you had though?
Of course I do. But I'm just saying, for most people, they're going to say, okay, if it's a hedge, I'll take 5% of my money and I'll buy Bitcoin.
Yeah.
And so my joke is, if the thesis proves correct and it's a zombie apocalypse Armageddon, you're going to lose 95% of your money, but your 5% will go up. Good luck to you. I mean, I guess, that's sort of like my
Yeah.
I sort of joke about it.
Yeah.
It's like, you're not going to be happy.
No.
Let's talk about payments to finish up. So payments is a very complicated space.
Yep.
There's Visa and MasterCard, which are the kings.
Yep.
There's everybody else.
Yeah.
So if we go back in time to COVID,
Sure.
As everybody was sitting at home
Yep.
buying stuff,
Yep.
everything went e-commerce.
Yep.
And all these stocks from Block
Yeah.
to Bill
Yeah.
to, Adyen,
Yeah.
you name it, these
Yeah.
stocks went in fuego.
Correct.
They went nuts.
Yeah.
And then but almost all of them had no earnings.
Yeah.
They had big revenue growth.
Yeah.
And then in 2023, the Fed raised rates.
Yep.
There was a big correction. The S&P was down 18%. But these companies were down, and it's statistically true, 70 to 90%.
Yeah. Yeah.
Okay. So when you're down 70 to 90% and then you have a rally, you're not back to where you were.
Right.
You're still way lower.
Yeah.
Tell me we're not going to get into all the payments. I mean, it is so complicated.
Sure. Right.
I mean, you put out an 85-page deck
Payments.
on payments, and I'm not embarrassed to say I read all 85 pages.
Thank you.
But I needed to take breaks because this is not easy. And what I would say, like, if I was still running a hedge fund and an analyst came to me and said, we should pick a name.
Sure.
Bill. And so I would tell the analyst, okay, write it up for me. And then I would start to do my own work. And the conclusion that I would reach is that this is a very complicated sector.
Yeah.
Everybody's now getting into each other's business.
Yep.
I need a virtual dissertation knowledge to really understand this sector.
Yeah.
I'll just own Visa, MasterCard, and I'll sleep at night. What do I need this for?
Sure.
What's your view?
Because I cover FinTech, I'll give you a broader view.
Right.
So separate from just digital assets, right? So when I look at
I'm talking about the FinTech public companies.
Yeah. Look,
Adyen, Block.
I really like verticalized business models.
What does that mean?
What I mean by that is payments companies like Toast that understand the specific needs of a specific industry vertical.
Oh, vertical.
And
Toast is a company that
Restaurants and
does
bars.
restaurants. And it not only gives them the payment system, it also gives them software to manage their back office.
I mean, the value add that you talked about earlier, right? What that does is it makes the life of the merchant easier.
Right.
And that then generates a revenue moat for the company. And it generates stickiness with that particular merchant, right? So I had dinner the other day in DC, and I was having dinner with a friend of mine, and I started talking to the restaurant owner. They use Toast. I was like, why'd you like Toast? I didn't know. Every time I ask this question, it's something new. Not only payments, right? Deliveries. They do even kitchen staff payroll now.
Okay.
So
you like if a company conquers a
correct.
vertical.
I quite like that.
So therefore you must not like Block, which is much more general.
I like Block for different reasons, but yes, they are far more general. They did very well in adoption when COVID came around. They made it easy. What I really liked about Block during that time was it made it very easy for anybody, whether you're a hair cuttery or you're a coffee shop, to quickly go online, to accept payments.
No, they had
offline,
their day,
online.
but I mean, if you look at the stock price of Block, it's been in this range for
correct.
years.
Yes.
I have a friend of mine who works at a hedge fund. The way he treats these as trading vehicles, not as long-term investments.
I think
because it's so complicated, and everybody's trying to get into each other's space.
Yeah.
Even like, by the way, what happened to, I saw Fiserv got rocked. It felt like some people are trying to encroach on their space, so their growth is down.
The acquisition business is tough, and acquire business. And look, my sense on payments broadly is, if you believed in the super app, which is when I'm going to use one app, be it PayPal or be it, Cash App, to do all of my work, right? And buy my insurance, I can buy my products, shopping. If you believed in that, then you would believe in the investment thesis back skyrocketed during 2020.
Right.
I've never bought into that. I don't think the super app strategy really works in the United States. I think it's really hard to keep people condensed for all of their financial lives on one app. I think it's a very different thesis outside the United States. So I think that took a bit of a slice out of that valuation post-COVID.
A slice? More than a slice. They lopped off half the body.
Right. So I think that is something that's tough. But again, like I said, I like verticalized business models a lot within payments. They have a bit more of a protective moat around the business.
Right.
Harder to commoditize, harder to challenge.
Okay. Thank you.
Thank you.
That was great. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.